What's up everyone, welcome back to our channel, and let's be real. Nobody wants to get that dreaded letter from the IRS. As a small business owner myself, I know firsthand how stressful tax season can be, especially if you're worried about triggering an audit. While the odds of actually getting audited are pretty low, the consequences can be a huge pain. Think hours spent digging through paperwork, potential penalties, and even legal fees. But don't stress out just yet. The good news is that most audits are triggered by common mistakes that are totally avoidable. In this video, I'm breaking down 8 of the biggest red flags that make the IRS raise an eyebrow, so you can stay off their radar and keep your hard-earned money where it belongs, in your pocket. By understanding these triggers, you're already one step ahead in staying compliant and protecting your business. So, let's get right into it, and make sure you're equipped to conquer tax season like a pro. Alright, so the first trigger might seem a little unfair, but it's the reality of how the IRS operates. They love to look at what's normal for certain industries and income levels. If your reported income is significantly higher than the average for your industry and business size, it might raise a red flag. Think of it like this: you wouldn't expect a lemonade stand to be pulling in millions of dollars, right? The IRS thinks the same way about different industries. Now this doesn't mean you should try to downplay your success. If you're killing it, that's awesome. Just be prepared to back it up. Meticulous record keeping is key here. That means keeping detailed records of all your income and expenses. And remember those receipts I talked about? This is where they come in handy. Keep every single one, no matter how small. Another pro tip: if you're working with a tax professional, make sure they're top-notch. Look for someone with a proven track record and experience in your specific industry. Let's talk deductions. Those magical things that can save you money come tax time. Every business owner loves a good deduction, and rightfully so. The IRS gives you these tax breaks for a reason: to encourage business growth and reduce your tax burden. But here's the catch: you need to be strategic and, most importantly, accurate. Taking large deductions that seem out of whack with your industry or income level is a surefire way to attract unwanted attention. It's like claiming you spent $10,000 on printer paper when you run a small Etsy shop. It just doesn't add up. Again, this doesn't mean you shouldn't claim every legitimate deduction you're entitled to. Make sure you understand the rules and regulations surrounding each deduction you claim. If you're deducting business expenses, travel costs, or home office expenses, you need to have the receipts, invoices, and documentation to back up every single penny. Think of it like this: you're basically telling the IRS a story with your tax return. Make sure it's a believable one with solid evidence to support it. Okay, this next trigger might seem a little nitpicky, but trust me, the IRS pays attention to the details. Using rounded numbers on your tax return might seem harmless, even efficient, but it can actually make you look suspicious. Think about it. In the real world of business, do you ever see perfectly rounded numbers? Not really. Your expenses are rarely going to be exactly $500 or $1,000 on the dot. The IRS knows this, and when they see too many rounded numbers on a return, it can raise a red flag. It might make them think you're estimating your income and expenses instead of relying on accurate records. I get it. Rounding numbers seems easier, especially if you're doing your taxes manually. But in the age of technology, there's really no excuse for sloppy bookkeeping. My advice? Use accounting software. It's a game changer for small business owners. Not only does it make tracking your income and expenses a breeze, but it also ensures accuracy down to the cent. Trigger number 4, the home office deduction trap. The home office deduction, a beloved tax break for entrepreneurs who run their businesses from home. But be warned, this deduction is also a common audit trigger if you're not careful. The IRS has specific rules about what qualifies as a legitimate home office. It can't just be any space you occasionally work from. It needs to be a dedicated area used exclusively and regularly for your business. So if you're claiming your dining room table as a home office because you answer emails there sometimes, think again. You need a clear, designated workspace that's used solely for business purposes. The simplified method is straightforward. You deduct $5 per square foot of your dedicated home office space, up to 300 square feet. The regular method is a bit more involved, requiring you to calculate the actual expenses associated with your home office, like a portion of your rent or mortgage, utilities, and insurance. Whichever method you choose, make sure you keep detailed records of your home office space, including measurements and photos. And remember, honesty is the best policy. Trigger number 5, showing business losses year after year. Starting and running a business is tough, and sometimes losses are just part of the game, especially in the early stages. But consistently reporting business losses on your tax return can raise red flags with the IRS. Why? Because the IRS's main goal is to collect revenue, and they're always on the lookout for what they call hobby losses. A hobby loss occurs when you're deducting expenses for an activity that's not actually intended to be profitable. The IRS understands that businesses can take time to become profitable, but they want to see that you're making a genuine effort to generate income, and that your business is more than just a hobby. Keep detailed records of your income, expenses, and all efforts you're making to grow your business. This could include marketing materials, business plans, and even notes from meetings with clients or potential investors. If you're consistently showing losses, consider consulting with a tax professional or business advisor to see if there are any strategies you can implement to improve your profitability. Schedule C, the form that strikes fear into the hearts of many small business owners. This is where you report your business income and expenses if you're self-employed or operating as a sole proprietorship. And because it's a common target for audits, it's crucial to make sure everything is accurate and above board. One of the main reasons Schedule C is so closely examined is that it allows for a wide range of deductions. While this is great for legitimate business owners, it also creates opportunities for abuse. The IRS knows that some taxpayers might be tempted to push the limits of what's deductible, so they pay extra attention to this form. So, how can you minimize your risk? First and foremost, make sure you're only claiming deductions that are legitimate business expenses, and that you have the documentation to back them up. Consider forming a separate business entity, such as an LLC or S corporation. This can offer some liability protection and potentially reduce your audit risk, as the IRS might view these entities as more legitimate businesses. And as always, if you're unsure about anything, consult with a tax professional. Who doesn't love a good business lunch? Meeting with clients, networking with potential partners, or even just brainstorming with your team. It's all part of doing business, right? And the good news is that you can deduct a portion of your business meal expenses on your taxes. But here's the catch. The IRS has specific rules about what qualifies as a deductible business meal. First and foremost, the meal needs to be ordinary and necessary for your business. That means a casual lunch with a client to discuss a project is probably fine, but a lavish 7-course tasting menu? Maybe not so much. You also need to be present at the meal, and it should be with a business contact like a client, vendor, or employee. Taking your significant other out for a fancy dinner and calling it a business meeting won't fly with the IRS. And remember those receipts we keep talking about? Yeah, you need those for business meals too. Make sure you keep detailed records of each meal, including the date, location, attendees, and the business purpose of the meeting. The IRS allows you to deduct 50% of qualifying business meal expenses. Using your car for business is incredibly common, especially if you're a small business owner or freelancer. And just like other business expenses, you can deduct a portion of your vehicle expenses on your taxes. But here's where it gets tricky. Claiming 100% business use of your vehicle is a major red flag for the IRS. Think about it. Do you really use your car solely for business purposes? No more grocery store runs, school pickups, or weekend trips. The IRS knows that most people use their cars for both personal and business use, and they expect you to accurately reflect that on your tax return. Claiming 100% business use when it's not entirely true can make you a prime target for an audit. So, how do you navigate this tricky deduction? You have two options: the actual expense method or the standard mileage rate. The actual expense method involves tracking all your vehicle expenses, including gas, maintenance, insurance, and depreciation, and then deducting the percentage used for business. The standard mileage rate is a set rate per mile that the IRS determines each year. For 2023, it's 65.5 cents per mile. Whichever method you choose, the key is accurate record keeping. So there you have it. 8 common tax audit triggers that small business owners should avoid. Remember, staying off the IRS's radar is all about being proactive, organized, and informed. Even if you're diligent about following the rules, it's always a good idea to be prepared in case of an audit. Keep those meticulously organized records, including income statements, expense reports, receipts, and invoices. Trust me, having everything readily available will save you a ton of stress if the IRS comes knocking. A qualified tax professional can be your biggest asset during tax season. Now I'm curious to hear from you. Have you encountered any of these audit triggers in your own business? Share your thoughts and experiences in the comments below. Let's help each other out.